Good afternoon to everyone joining our weekly market update. It is the first one of 2023 here on January 9th. And let me just start off by welcoming all of our clients and advisors and friends and family and anyone else that might be joining. We know that 2022 was a rough and challenging year for investors of any asset class, but in particular, for growth investors. So even within our universe, we know that the most challenging year was within those growth strategies and those growth mandates. And what you also notice is that unlike other growth strategies or funds or ETFs out there, we're not sitting idly by. We took steps to really say, what is 2023 going to look like? Getting back to our 2021 and prior year process of understanding the market from top to down and really looking to see, based on the macroeconomic picture, based on the quantitative backdrop, based on the interest rate and credit market environment, where do we see those flow of funds heading toward in the new year and beyond? And what are some of those secular leadership changes that we want to try and anticipate and get in front of, as opposed to trying to chase things? Now, in 2022, most of the damage was done between the months of January and May. And really, since May, it was about sort of just stemming damage, treading water. It was volatile, but overall treading water. Now it's time to say, okay, we're in the latter stages of what we believe are the latter stages of this bear market. What are those green shoots that we're starting to see in the market? Where are the points of evidence as to where the next cycle's market leadership is? And starting to get involved today when everyone is pessimistic, when everyone thinks the world is going to end. That is usually when we want to look for those signs of the leaders of the next market cycle. So that's what our prime focus is going to be on this week's update. So I'm going to go ahead, share my screen, and we're titling this week's presentation Back to the 2000s. Why? When we look at the market from top down, bottom up, and we look at prior leadership from 2010 through to the early part of last year, and where we see leadership evolving, it looks a lot like the 2000 to 2002 transition period, where we had this big high-tech bubble that lasted for about 10 years in the 90s, late 90s into 2000, popped, flow of funds heading toward those low-cost areas of the market, such as industrials and commodities. So in other words, rock over paper. And that's really where we think this current market is heading towards. So three big things that we want to focus on today. Understanding the impact of that China reopen. We think this is probably one of the most understated and most misunderstood phenomenons that's happening in the global economy right now. Number two, shifting away from the top of the market toward the average stock. We think that's a huge theme for throughout the 2020s. And then lastly, what we think is breaking out in a bad market, and what is that telling us about the overall state of the market? So one thing real quick from a high level point of view, whenever you get a very negative year, calendar year, like you did in 2022, the next year historically tends to be pretty damn good. And so, we don't want to be overly pessimistic here. At the same time, we do think this is more like the early 2000s. So there is always a chance that the actual headline index could struggle here this year. But underneath the surface of the market, we think that there's emerging bull markets that are taking place, but they're just going to happen to be in some of the smaller areas of the market, not in like technology or healthcare or biotech. Now, to navigate this, we do think active investing will be key, right? So in other words, not just blindly putting money in an index where that index, the S&P 500, is almost 50% weighted in technology and consumer, but picking our spots. So do we want to go value versus growth? Within value, what are those areas that are actually accelerating toward growth? Because that's the needle that we want to try and target. Secondly, mega cap versus mid cap versus small cap. What are the market cap ranges that we think are going to outperform in this sort of market environment? And lastly, US versus Europe versus EM. We've had about 15 years of US dominance. We also think that is about the shift over back toward Europe and the EM and Japan and China. And that has important implications as it relates to the commodity cycle, as it relates to energy demand, as it relates to overall global diversification mix. So we want to be cognizant of all of that. Now, the China reopen. The way that I've been comparing this in phone calls with both clients and advisors is think of the US reopen 2 years ago as being, if you were sick for a couple of weeks, you're under the weather, you've been in the house, you're getting cabin fever, you finally feel better and you want to go out. You want to go have some drinks, you want to go out for dinner, you want to go hang out with friends and family. That's sort of what the US reopen was like, right? It was a soft closure for about 6 months. A little bit harder in some areas, and a little bit easier in other areas, but generally speaking, you still go to the grocery store, you had to wear a mask and things like that. In China, it's a completely different story. For about 2 years, 1.41 billion people have essentially been jailed. When we think of the camps that were set up, when we think of the iron fencing around people's condominiums, high-rise towers, doors nailed shut, this was essentially a jailing of 1.4 billion people for 2 years. So the comparison we like to use is not being sick for a couple of weeks and getting cabin fever. It's literally being like, imagine if you were in actual jail for a few years and then getting released overnight, not even knowing you were going to get released. And then in the morning, someone says, you're free to go. You're going to go absolutely haywire. You're going to absolutely just be drunk with freedom. Right? And that's what we think is the beginning signs of what's happening in China. That has very important implications, because when 1.4 billion people suddenly change their behavioral habits overnight, that's driving up use of commodities. That's driving up use of consumer goods. That's driving up use of gasoline. All of these things are massively important, and we've positioned the portfolio to anticipate that level of demand. So we think that reopen is on steroids relative to the US reopen. The main industries impacted: commodities, housing, travel, those hard commodities in particular. That's how we want to take advantage of this. You'll notice in the portfolio, copper exposure, metallurgical coal exposure, energy exposure. Energy, a little bit more mature in the rally. Those other sectors, though, including gold, very early first inning type of rallies. So from a more 2020 to 2030 theme, back here in the US, stateside on the S&P 500, for the last 15 years, we've seen this massive dominance, this huge outperformance from the FANG stocks: Microsoft, Apple, Netflix, Google, NVIDIA, you name it, right? The top two, Apple, Microsoft, made up about 13.2% of the index, far larger than we saw in prior market peaks. Even with the entire sell-off that we've seen, they're still 11.1%. So what's the big message here? We're at the top. So right now, what we want to try and do from an asset allocation standpoint is that we think that the risk is at the top of the market, and we think that the opportunity is actually in favor of the average stock. So as money comes out of the top of the market, those FANG stocks, those high market cap or large market cap technology stocks, those flow of funds is going to make its way down toward the smaller sectors of the market. So we want to understand today, where is that money going to go toward and have an outsized impact? Because remember, tech, communications, and consumer, that is 44% of the S&P 500. To put this into perspective, energy, with that entire rally that it had last year, is still only 5.18% of the S&P 500. Materials, 2.76% of the S&P 500. Metals and mining, one of our biggest overweights right now, only 0.45%. So imagine what happens when you got half of the stock market that's suddenly on the move and trying to find a home. We think that these sectors are going to be disproportionately impacted in a massively positive way by these flow of funds. And we also see that in terms of the relative performance. When we simply look at the S&P 500 equal weight, so in other words, it's not market cap weighted where Apple represents a disproportionate percentage of the S&P 500. Apple in this case represents the same percentage as all the other 507 stocks on the S&P 500. The equal weight relative to the S&P 500 versus the top 50 index, so top 50 stocks of the S&P 500, is breaking out. And you can see that top 50 index is breaking down. So the top 50 largest stocks in the S&P 500 breaking down, the S&P 500 equal weight breaking out. We think that's an important secular signal as to what's happening with flow of funds away from those largest companies and toward the average stock of the S&P 500. We even see it with the style, right? So growth versus value. Growth was dominant for the better part of a decade. And what do we see here? Growth is continuing to break down, broke support earlier this week again, even though it was technically oversold. And small cap growth versus value, again, reaffirming and confirming that breakdown. Another big cycle that we've been following, and we've talked about this many times in the latter part of December, was the US dollar cycle. Big peak here in 2000. We saw another big peak. We saw another big peak here in, call it 2020, 2022 or so. Pardon me. In 2022, right now, we believe that we're in another big peak. Why is that important? When the dollar's in a secular bull market, gold is in a bear market. When the US dollar is in a bear market, gold tends to be in a bull market. So what we saw here was that the US dollar went into a secular declining period in the 2000s. This was a historic bull market for gold. US dollar bottoms 2008 all the way through to basically the third quarter of last year in 2022. And gold's been in a bear market ever since. We think this is a very important peak. And we think this is an important peak for many reasons. One, the US was the first to raise interest rates. We think they're going to be the first one to reach the peak interest rate period, and that Europe and Japan are going to catch up. So for interest rate differentials are going to contract between countries, and that's going to drive down the value of the US dollar. Secondly, we also do think that that safe haven rush that we saw last year is going to start to taper off, and that should be good for gold as well. And you can see here, even earlier this week, despite a lot of the hawkish Fed commentary, Bullard, who's often considered the most hawkish within the Fed, says that rates are getting closer to being sufficiently high. And we think that's good for gold. Why? Because gold is a hedge against the US dollar. Remember, it's not a commodity, it's a currency, and it is a hedge against that US dollar. And we're already starting to see that market DNA start to change. Since the dollar peaked on October 24th of 2022, gold is up 12.4%. The NASDAQ, otherwise the tech-heavy NASDAQ, is down 4.6%. We look at since September 27th of 2022, again, gold is up 13.8% versus down 3.6% since September 27th. Now, I would note that this is since the dollar peaked, and this is since the 10-year yield peaked. So again, we can see the price of gold here, a very strong breakout. Remember what we were talking about. In bear markets, look for the asset classes that are bottoming ahead of the overall market. Remember, the S&P 500 still looks terrible, looks rough, everything else from a technical backdrop. Gold bottoms way back here in September, okay? And it's been breaking out higher ever since. And when we look at gold positioning across the market, consensus remains relatively agnostic, right? Before, in prior periods where we had strong peaks in gold, we had almost everyone bullish. Not too many people are bullish right now. We look at gold ETF flows, still very, very low. We're not even close to where we were a few years ago. So from a flow of funds standpoint and from a bullish versus bearish standpoint, again, all of these are factors that we think are positive for the price of gold and therefore the price of gold stocks. Again, copper seeing similar price action. Copper is breaking out. This is just something we don't see ahead of recessions. We know that the overwhelming narrative right now is for a global severe recession. We do think the economy is going to slow down. We mentioned that many times in Q3 and Q4 of last year. We're just not there in terms of the end of the world. And while we are avoiding technology and we are avoiding high-priced growth stocks, we think there are areas of the market that have already bottomed. And we think materials and copper and gold and iron ore and even the banks to some degree, we think those areas have largely bottomed. Now, we could be proven wrong, but we think that the market is trying to tell us something that this is less about a 2008 type of scenario, and it's more of a 2000, 2001 backdrop where we're seeing a secular shift from one set of assets to the other, and we want to be on the receiving end of those flow of funds. So bottom line here, ladies and gentlemen, after a miserable year, we do think the contours of the next bull are beginning to take shape. Prior leadership, such as technology, unlikely to make a return to leadership. Why? You just simply don't see that throughout history where the prior leadership becomes new leadership with a new bull market. It's usually something else taking its spot. As the market has moved lower, gold and commodities have been moving higher. Again, not something you typically see in a deep recession because those, with the exception of gold, commodities are economically sensitive. So if you're going into a recession, you would tend to see those prices drop off. And we do think that the China reopen could very well be the story of 2023, positioned for as such here in the US. So in other words, commodities and hard assets that benefit from 1.4 billion people suddenly needing them, positioned for that. So that's what we got for you this week. If any questions, please feel free to reach out to your advisor or our office here at 888-543-3776. Thank you again. Happy New Year, and hope to speak to you again soon. Talk to you later. Bye.